11. Jesse Livermore, the 1929 crash. Result: $100 million profit. Livermore can be classified as one of the world's pioneers of shorting the market. His first short was on Union Pacific, earlier before the San Francisco earthquake of 1906. He profited £250,000 on that trade. He accompanied that up by shorting the market in 1907. As the stock market crashed, he took home $1 million. Always searching for the subsequent target, he landed on the wheat enterprise in 1925, that earned him $3 million. He was gaining a lot of recognition, however his best trade ever would make his prior trades pocket change in comparison. In 1929 the Dow Jones was up five-fold in 5 years and he was not as hopeful that it would rise anymore. As the cash flowed in, achieving an $8.5 billion high, it hit a point loans had surpassed the quantity of cash in circulation. As stocks started to degree out, Livermore gambled on his largest short in 1929. Livermore shorted the complete market. As the U.S. financial zone went into meltdown, Livermore earned himself $100 million, which in today's market would equate to a $1.4 billion. Livermore was however declared bankrupt and was banned from the Chicago Board of Trade in 1934, 5 years after his biggest success as an investor. No one is aware of why and how he misplaced all his money, however his recognition as one of the best traders nonetheless stands to this day. 10. Paul Tudor Jones, shorting Black Monday. Result: $100 million profit. Black Monday took place in October 1987, however Paul Tudor Jones noticed it coming earlier than that. There will be some kind of a decline in the subsequent 10, 20 months, and it will be earth-shaking, he said in early 1987. Tudor Jones began trading in 1976. As he was bored, he enrolled at Harvard Enterprise School, only drop out at the final minute and proceed to specialize in trading through experience instead. After working for Eli Tullis, he quit to founded the Tudor Investment Group in 1980 after becoming a profitable macro fund manager. In 1987's bull market, he spotted an overvaluation in stocks. He and Peter Borish spent hours studying graphs of the Wall Street crash of 1929. Analyzing the historic markets and income statistics, and cited direct comparisons to the previous 1929 major markets crash. With that information, they pulled off one of the best trades in Wall Street history. 2 weeks earlier than that fateful October day in 1987, the Tudor Investment Group started positioning itself, trading in opposition to the market aggressively as the relaxation of Wall Street remained both oblivious or unprepared for the bubble to burst. After shut of commercial enterprise on the 19th October, the Dow Jones dropped a whopping 22% in one day, breaking several data such as its biggest ever proportion drop at the time, requiring the graphs used through TV research to be redrawn with new decrease limits. Tudor Jones walked away with $100 million in popularity as one of the shrewdest traders around. He grew to be legend following the launch of a PBS documentary, Trader, a documentary following Tudor Jones during 1987. Tudor Jones hated the documentary so an awful lot that he reportedly demanded it be taken out of circulation and bought up as many copies of the VHS model as possible. Occasionally, it resurfaces online for a few hours then rapidly removed. However, if you can get a copy, it is really informative. Tudor Jones is presently rated by Bloomberg Billionaire Index as one of the wealthiest hedge fund managers in the world. Current net worth being $8 billion. 9. Andy Krieger vs. New Zealand result: $300 million profit. Following Black Monday, an aggressive dealer working for Bankers Trust through the identify of Andy Krieger started out gazing some of the world's currencies that had been rallying towards the battered US dollar. Andy Krieger was working for Salomon Brothers. In 1986 he was taken by Bankers Trust. Trading shortly won him recognition and additionally the trust of his employers. In truth, Krieger's prowess was such that Bankers Trust allowed him to trade with a up to of $700 million, which was a whopping $650 million greater than nearly all his counterparts. But it was his work in 1987 that cemented him as a trading legend. In the aftermath of Black Monday, as all the traders fled to different currencies that had suffered much less in the crash, Krieger noticed that some have been being considerably overvalued. One such was once the New Zealand dollar, or as nicknamed, the Kiwi. Krieger determined through his analysis to make a move on the Kiwi. He used options, which at the time had been a new technique, to sell the New Zealand currency up to $700 million, with some articles suggesting he had a massive $1 billion position. Krieger's position was so big that it is claimed to have been larger than the cash supply of New Zealand as a whole. The New Zealand government tried to stop the move. It didn't work. Despite a call from the New Zealand authorities to Krieger's employers, Bankers Trust. However, it was too late. The strain on Kiwi proved too much for the market, and as different hedge funds fell in line with the short, the Kiwi slipped 5%, turning Krieger's trade into a $300 million profit. Krieger himself was once paid what he calls a tiny bonus of $3 million only, and that started out a sequence of activities that led to him leaving Bankers Trust and going to work for George Soros at Quantum. He has however moved on to work for Northbridge Capital Management. 8. Betting on Saddam Hussein and the Iraq War. Laius Bacon. Result. Estimate $430 million. Bacon had already secured a win, having a bet in opposition to the markets on Black Monday at the identical time as Paul Tudor Jones. However, that wasn't his largest triumph. Lewis begun his profession while studying for his MBA at Columbia Business School. He traded commodities in his first 3 semesters from a loan he had acquired. It was to be a humiliating start. Having made losses each and every year, he resorted to asking his father for a loan to cater basic needs. In his 4th year, he made his first profit. After a few years of success and cooperate ladder climbing, such in Bankers Trust, and working his way up to vice president of the futures division at Shearson Lehman Brothers, he fashioned his very own company, Moore Capital Management LLC, in 1990 with $25,000 he inherited, and pulled off one of the best trades ever. Spotting developments of hostility from Saddam Hussein's regime in 1990 in the direction of oil-rich neighbor Kuwait, he was determined to engage in some unconventional strategies by way buying oil and shorting stocks. That year, his agency began with a fund of around $100 million in 1990 and made a return of 86%. He continues to reign in trading, returning between 25 to 35% a year for over a decade. While others fluctuate wildly, Bacon's capacity to study markets continues to reap rewards for these who make investments with him. 7. Jim Chanos shorted Enron. Result. $500 million profit. Chanos started working as an analyst in the 1980s. He moved between a handful of companies and secured his first massive win working for Guilford Securities, when he shorted a U.S. insurance plan corporation, Baldwin United. He investigated and found Baldwin had been selling insurance policies and then making up their books, based on assumed earnings from potential sales and income that did not exist. Something that would later be replicated with Enron. Following the profitable trade leading to the disaster of Baldwin, Chanos set up his personal hedge fund, Kynikos, Cynic in Greek, in 1985 with $16 million. It was the fall of Enron that would give Chanos his largest win and warranty his reputation on Wall Street. Chanos' involvement began with a call from a friend telling him to take a look at an article in the Texas Wall Street Journal by Jonathan Weil. The article detailed the celebrations of energy companies successfully lobbying the SEC to permit mark-to-model and mark-to-market accounting to be used in their businesses. Mark-to-model genuinely approved these agencies to take the value of their future profits and add them into their accounts. Following this, Chanos and his pals at Kynikos started analyzing Enron and observed a few red flags, like they had been using mark-to-market accounting to rub down the books and boost profits while hiding the losses in their discounted operations. He then made his trade, when the CEO Jeff Skilling stepped down citing family reasons. So in November 2000, as Enron's stock hit $90, Kynikos initiated a short. What a company does the biggest corporation cave and monetary fraud case Wall Street has seen. Chanos made around $500 million income on his shorts for Kynikos, and his fame and reputation grew exponentially as a result. 6. George Soros. Bet against the pound. Result. $1 billion profit. This is one of the most famous trades ever and earned Soros the nickname, the man who broke the Bank of England. In 1992, the British financial system was regarded to be performing nicely to most observers. However, according to the European exchange rate mechanism, ERM, the pound had to stay inside 6% against currencies who operated inside this system. The trouble that the Bank of England had used to be that appearances can be misleading, and as the German mark persevered to operate strongly with low inflation, Britain's inflation was worse than their German counterparts. The Bank of England's hope that the ERM would minimize inflation used to be noticed as a fallacy by using George Soros and his quantum fund. With this in mind, Soros, seeing tries to cover a currency in trouble, made his move. He started to borrow billions to short the pound, taking up trades that were above $4 billion against the pound. The Bank of England, in an effort to stop the inevitable, raised their interest rates to 12%. This actions worked against them, as to different traders it signaled that there was an issue with the pound's stability, and the government quickly realized that paying back the interest on a struggling currency was going to rack up billions in bills. An attempt to increase the rates to 15% was aborted, and the Bank of England conceded defeat, exiting the ERM and watching as the pound fall by 25%, on a day that would be coined Black Wednesday. Although later some would refer to it as Golden Wednesday, because it signaled the beginning of a stunning resurgence for the pound. Either way, Soros had walked away with $1 billion for his efforts. Soros, however, stepped away to focus on philanthropy in 2000. However, he stays an icon of Wall Street. 5. Big bet on the Deutschmark, twice. Stanley Druckenmiller. Druckenmiller had been trading since 1977 with tremendous success, which is why in 1988 Soros brought him on board at Quantum. His first bet on the Deutschmark was at some point of the fall of the Berlin Wall. The markets had been very extreme on the possibilities of the East and West German reunification, and as a result, the mark currency sat in a role that Druckenmiller thought to be too excessive. Seeing the possible miscalculation and studying the strength in the financial system, Druckenmiller started out a multi-million-dollar guess on the mark to rally. This rapidly elevated to $2 billion following assist from Soros, who was speedy to help and share Druckenmiller's vision. Over the subsequent few months, their role that the forecasts had been harsh and the future used to be brighter than others contended, Druckenmiller's first bet gave him a return of 60%. Druckenmiller's second play, once more involving Soros and the Quantum Fund, was to be even extra successful. As Soros battered the Bank of England, Druckenmiller sensed the chance to bet on the mark again. Beginning by buying up British stocks on the assumption that as the pound dropped, which it did spectacularly, and that exports would increase, he followed that by buying up German bonds, guessing correctly that other investors would follow during the fallout of the pound. The trade was a stunning success, earning an additional $1 billion. Druckenmiller persevered to work with Soros till 2000, when they parted ways following a sequence of massive losses in the technological market. Deciding to continue, Druckenmiller formed Duskin Capital Group. He, however, closed down in 2010, citing a high emotional toll of managing the fund. 4. 2020 crash, Bill Ackman. Result: $2.7 billion. Ackman established an investment firm, Gotham Partners, in partnership with Bruce Berkowitz in 1992. He, in collaboration with the insurance and real estate firm, Leucadia National, made a bid for Rockefeller Center. In 2004, with $54 million from his personal funds and his former business partner Leucadia National, Ackman started Pershing Square Capital Management. 2005, Pershing bought a significant share in the fast food chain Wendy's International and successfully pressured it to sell its Tim Hortons donut chain. Wendy's spun off Tim Hortons through an IPO in 2006 and raised $670 million for Wendy's investors. After a dispute over executive succession that led Ackman to sell his shares at a substantial profit, and the stock price collapsed, raising criticism that the sale of Wendy's fastest-growing unit left the company in a weaker market position. Ackman blamed the poor performance on their new CEO. In March 2020, Bill predicted the effects of coronavirus on U.S. economy. With a bet of $27 million, he shorted the stock market and made a mouth-dropping 100x return. He earned $2.5 billion from the trade. 3. 2007 crash, Kyle Bass. Result: $3.5 billion profit. He was one of the largest winners of the credit default swap trades in 2007. Starting at Bear Stearns, he rose rapidly to managing director at the age of 28. After a spell with Legg Mason, he commenced his personal firm, Heyman Capital Management LP, in 2006 with $5 million of his cash and $28 million from investors. Base had been trading efficiently for some time. However, it was a wedding ceremony in Spain that would start the chain of occasions that would lead to his biggest trade. A dialogue with an funding banker from New York about the subprime CDO market resulted in Base hiring a crew of non-public investigators on his return from Spain to research the U.S. personal loan market. He then did something that was nearly unheard of. He started out buying CDSs as a wager towards the multi-trillion-dollar subprime personal loan market and, in essence, in opposition to the whole international monetary system. Base managed to persuade extra buyers to come on board, and the end result was a close to $4 billion income for his hedge fund. Following his large win in 07-08, Bass has enjoyed success with Heyman Capital, returning 578% since inception. 2. The Big Short, John Paulson. Result: $4 billion profit. He was well-known winner from the Big Short. A profitable if unremarkable dealer in 2006, no one anticipated Paulson to be the man who gained big. Having set up his very own hedge fund, Paulson and Company, in 1994 with $2 million, in an workplace rented from Bear Stearns, he'd elevated it to control around $100 million. However, in comparison to Wall Street, he wasn't considered as a massive player. All this changed when he and his analyst, Paolo Pellegrini, began to look into the U.S. housing market. He managed to get round $150 million from investors, a notably small amount, and then persuaded the banks to promote him credit default swaps, which are essentially insurance plan towards debt. Then he and Pellegrini waited. Their concept paid off in such an remarkable manner that when, in the course of 2007, as matters started to fall aside for massive banks, their investors thought an email revealing profits of 66% was a misprint and should have read 6.6%. On some days they were making over $1 billion a day. By the end of 2007, Paulson and Company had made $15 billion, and they hadn't finished. As the markets continued to collapse, Paulson raked in another $5 billion for the fund, and estimates put his own personal take at $4 billion. Paulson has continued to trade, and has these days moved into the gold market. 1. David Tepper, Beleaguered Banks. Result: $7 billion profit. Imagine yourself again in 2009 and the global monetary disaster had hit. The Dow Jones used to be on the ground, and some of the largest banks like Lehman Brothers and Bear Stearns, ever present on Wall Street, had closed their doorways for the last time. As cash and confidence flowed out of the banks and talk of nationalization reared its head, you would have to have been stupid to buy bank stocks. Or so everyone but David Tepper thought. David Tepper began his financial career with an MBA and a treasury position at Republic Steel. He was recruited by Goldman Sachs in 1985 as a credit analyst, and within 6 months, he was the head trader on the high-yield desk. He left Goldman in 1992 and set up his personal fund, Appaloosa Management. He started trading on his very own in 1993. In the years that followed, Tepper's fund was recognized for its volatility. However, they managed to yield an average of 30%, which meant that when he came out of 2008, 25% down, his investors stuck by him. While everyone else was distracted by what was happening in the moment, Tepper saw the long game and decided to move his fund into the most dangerous market in town, banking. Tepper made his play in early 2009 as the big bank stocks were so depressed that onlookers were convinced more would be closing within 6 months. By contrast, Tepper became convinced that the banks would rally. He studied a government white paper released in February 2009, announcing its financial stability plan, which was designed to shore up the banks. The government was buying in bank stocks which would be converted into common shares at prices exceeding the current value. Tepper decided it was time to buy. He purchased some of the biggest banks' common stocks at very low values in big numbers. Tepper's firm reportedly purchased Citigroup shares at 19 cents to the dollar and Bank of America at 12 cents to the dollar, in addition to roughly $1 billion worth of AIG's commercial mortgage securities at 9 cents on the dollar. He sat back throughout 2009 and watched them double, then triple and, in BOA's case, quadruple within a year. As Appaloosa returned 132.7% by the end of the year to net, Tepper made a staggering $7 billion. The move was so gutsy, it has almost become folklore, with some people claiming Tepper keeps a pair of brass testicles on his desk. A reflection of the steel it took to enter that market at that time. Tepper was named as Institutional Hedge Fund Manager of the Year for 2009. His success has continued and he was named Forbes's top hedge fund earner of 2012. Although by his own words his fund is consistently inconsistent, he regularly features in the top hedge fund managers year on year.